Rate cut hopes grow, but buyers are still holding back. Despite whispers of interest rate relief from the Bank of Canada, the Fraser Valley real estate market remained pretty quiet in April. Jordan here with your Fraser Valley Market update for May of 2025. Sales crept up just 1% from March to 1,043 transactions. They're still down 29% compared to this time last year. Inventory also surged to over 10,000 active listings, a level we haven't seen in more than a decade, giving buyers time, selection, and negotiation leverage. The trouble is, buyers aren't rushing in. Typically, the spring market, April, May, early June, is the busiest time of the year sales-wise. The momentum gained during the spring usually insulates price points through the slower summer months. Without the spring momentum, we may see slower summer sales and a further price erosion. The overall sales to active listing ratio now sits at 10%, firmly in buyer's market territory. The board considers the market balanced when the ratio sits between 12 and 20%. Benchmark prices have started to erode, albeit gradually. Detached homes are down 1.3% year over year, townhomes down 2.4% year over year, and condos down 3.2% year over year. If sentiment continues to slip, we could see a more aggressive race to the bottom, similar to what happened in spring of 2022. It's not there yet, but the cracks are starting to show. The composite benchmark price in the Fraser Valley fell 0.2% in April to $972,700. Looking at HPI benchmark prices by property type, single-family detached actually increased to $1,506,600. That's up 0.1% compared to March of 2025. That's still down 1.3% compared to this time last year, though. Townhomes fell to $833,100, down 0.1% compared to March, and down 2.4% compared to April of last year. And lastly, apartments fell to $537,800, which is down 0.6% compared to March, but down 3.2% compared to April of last year. Despite the slowdown, good listings priced right are still moving. Median days to sell in April were 14 for detached versus 32 average, 13 for townhomes versus a 29-day average, and 19 days for condos versus also a 29-day average. So while it's taking longer on average, homes that are perceived as strong value are still attracting quick offers. The issue though, fewer of those deals are being picked up. Chilliwack townhomes continue to lead the way with a strong 24% sell-through rate, down slightly from March, while Pitt Meadows is still showing seller's market conditions for attached product. Most other attached home markets are sitting in balanced territory. Detached homes, however, are sluggish almost across the board. Surrey Central, for example, has a detached sell-through rate of just 5%. This matters. If you're selling a condo or townhome and moving up to a detached, the market is on your side. The inverse, though, is trickier. This divergence is impacting homeowner strategies across the valley. If you'd like to see breakdowns by city and property type, check out the market area page at jkre.ca. Anecdotally, we're starting to see a wave of relists. Sellers who didn't get traction in March or April are pulling their homes, adjusting expectations, and coming back to market. If these sellers begin pricing to be the first to sell rather than holding out, downward pressure could accelerate. At the same time, falling interest rates might provide some support if the Bank of Canada continues on a dovish path. The next rate announcement is June 4th, and I'm betting on a 0.25% drop, but I suppose we'll have to wait and see. 5-year bond yields have spiked slightly, and at time of recording, they sit at around 2.75%. So I don't expect any relief on fixed rates coming anytime soon. All that being said, the soft sales numbers aren't just about rates or inventory, they're about confidence. In March, Canada lost 33,000 full-time jobs, pushing the unemployment rate to over 6.7%. Surveys show consumer confidence slipping, and many households are hesitating to make larger financial moves. Adding to the uncertainty, the Liberals won a 4th consecutive term in April under new leader Mark Carney. While Carney's leadership was positioned as change, 88% of his cabinet is made up of returning Trudeau-era ministers. 12% change is something, but I don't personally feel it's nearly enough. Policies like emissions caps, increased carbon taxes, and a projected $62 billion federal deficit in 25 and 26, an additional $130 billion in deficit spending over 4 years, all remain in play. RBC notes that 80% of Canada's GDP growth in recent quarters came from government spending, a level of dependence that economists warn is entirely unsustainable. Meanwhile, Canada ranks near dead last in the OECD for GDP per capita growth over the last decade. This erosion of prosperity is showing up in sentiment. An Angus Reid survey found nearly 4 in 10 new immigrants are considering leaving Canada, citing cost of living and lack of opportunity. So where does that leave us? Well, locally, we have record inventory, softening prices, and a tale of two markets depending on property type, attached versus detached. Nationally, we have stagnant growth, rising job losses, and policies that could spook both investors and residents. Rate cuts might provide some short-term lift, but without restored confidence, that may not be enough. But as always, it's critical to understand the dynamic in your specific market segment. If you're selling a detached home in a slower area, you may need to be more aggressive on pricing. If you're looking for a turnkey property in a hot, attached segment, expect some competition. But what do you think? Are we heading towards a deeper correction, or will the Bank of Canada pull us out just in time? Do you think continued deficit spending and regulatory expansion will help or hurt the market long term? Drop me a message or comment. I'd love to hear your take. And if you're thinking about making a move now or down the line, let's chat about your options. Thanks.